We've all been there before. You have a great conversation with a client. You're like, man, this relationship's great. You get all the documents. You're trying to put it into the portal and get it approved. And then you get refer eligible findings, or refer with caution, or approve ineligible. And you can't get the deal approved. And you're like, damn, I worked so hard with this client. I built the best relationship. Why God, why me? And you don't know how to get it approved. I'm here to tell you today that I get most of these situations approved with certain tricks you could do to hack the system and get approved eligible findings every single time. And today I'm going to show you the secrets and tips to get your loan approved when it's a sticky situation. My name's Alex Sharafity, and I've been doing mortgages for the last decade plus. Was at Rocket Mortgage as a top banker, then a top leader, then a top senior leader, then a trainer, then a mortgage consultant for mortgage companies and originators across the country, including the #1 brokerage in the country, West Capital. And now I'm doing it here with my own brokerage, and I'm originating myself. That's why I know how to get a loan approved, and I know how to do it very well. And today we're gonna go over the 5 or 6 things that you could start doing to get your loans approved. So let's jump straight into it. The #1 thing that I always start with is, of course, DTI. Your DTI sometimes on a conventional loan or an FHA loan and even a VA loan really matters. On a VA loan, typically it's up to 60% or up to meet the sheet findings. On an FHA loan, you could sometimes go all the way up to 50 or 57%. On a conventional loan, it goes anywhere from 43 to 45 to almost 50% with assets. Now, when you're trying to get an approval for a loan, one of the things that you could switch if you're not getting an approval is a lot of times you'll be at 47% debt to income, or you'll be at 51% debt to income, or even 41% debt to income. And there's certain thresholds on the debt to income ratio that make it look less risky and increase your eligibility of getting it approved, increase your odds of getting it approved. And those numbers are not these here, but the sweet spots is 43% debt to income or under. Then it goes down to 37% debt to income or under. And sometimes it even goes down to 30% or under. So a lot of times if you're not getting loans approved, try tweaking the debt to income ratio by paying off more debts or extending the term or finding a cosigner or making sure you're using all the income, and try adjusting the debt to income. It'll work a lot of times, and you'll find that the loan will go approved that wouldn't go approved. #2, your LTV. So the LTV won't let me be your let me be me, so let me see. They tried to shut me down with LTV, but it seems so empty without me. So the LTV, a lot of times you're pushing these loans to 80% if you're trying to get max cash out on a conventional, or you're going to 90 or 100 if you're doing an FHA loan. And a lot of times Fannie Mae and Freddie Mac don't like that because you're maximizing the limit of equity. So they're like, this client is trying to take out all of their cash out of the home, the maximum. It's a little more risky because you're trying to maximize your loan amount. So a lot of times what you want to do is drop this loan to value to 75%. And really the sweet spot is 70%, 65%, 60%. So in a lot of cases, if the client has flexibility and you don't have to go to 80, try tweaking the loan amount down to 75, 70, 65, 60. And a lot of times you'll find you will get approved eligible findings when tweaking the loan to value. #3, this one just happened today. Today, I had a client with a 465 credit score, and they had good income and the loan to value was good. The debt to income was even good, but I couldn't get it approved eligible. And you know why? It's because I was only doing a 30-year. So guess what I did? I tried 27. Nope. Tried 25. Nope. Tried 20. Nope. Then tried a 15, boom, approve eligible findings on a 15-year mortgage. Now to me, a 15-year, it's more risky because the payment's bigger, but it's less risky because the client is showing that they want to pay off their house faster. So I guess in investors' eyes, sometimes a 15-year looks better than a 30-year and it gets approved. So if you're ever stuck, try switching the term and going to a lower term and you might get an approved eligible finding, okay? So far we got loan to value, tweak it down so it shows more equity in the home. Debt to income, tweak it down so it shows the client has the ability to pay their bills. Then we got the term, tweak it down so it shows the client's responsible and they want to pay off their debts. Here's another one for you. Assets. So many times I can't get a loan approved, then I add some assets in there and it goes approve eligible. It doesn't only have to be liquid, checking and saving. It could be, annuity, pension, IRAs, life insurance with a cash value, 401k. They don't have to use these assets. They just have to show these assets. And a lot of times when you show these assets, the investor, Fannie Mae and Freddie Mac, see this person has assets. They have a little security and they'll give you the approved eligible findings. If all of these fail, you still have another option. You know what that is? That's the credit, Giving your client a credit repair and telling them, hey, pay off this credit card that's maxed out. Or, hey, this one's disputed, let's get this off your account. Or, hey, if this is not for you, let's get it off of your name. Looking at their credit report, figuring out what's going on and trying to get their score up. Like if they're at a 618, I promise you getting them to a 620 might make a difference. If they're at 638, getting them to 640 might make a difference. If they're at 685, getting them to 700 might make a difference. So a lot of times with the credit, the way it works, especially on a conventional loan, is the credit brackets are every 20 points. So, 620 to 640 is different thresholds, different pricing. 640 to 660, 660 to 680, to 700, 7 to 720, 720 to 740. All these have different pricing and different thresholds. So a lot of times I can't get a client approved. They're at 638 credit. 3 months later, they're at 642 credit and it goes approved. So these are all different ways that you could get a loan approved. Make sure that you're maximizing and trying all of these ways. When you have a client with a sticky situation or an iffy situation that is not working out for you, not getting approved, make sure you check the loan to value, you check the debt to income, you play with the term, you add assets, and you see if there's any possibility to get the credit up. And here's a bonus for you. If none of these work and you tried them all, you could literally look in the mirror, tell yourself, I did everything to get this client qualified. I'm comfortable with moving on now. Now, a lot of times we get upset because we're like, we wasted time. We tried all these things. Trying all these things might take you an hour. I get it. I do it all the time. But if you nurture them the right way, I'm not even going to draw it here because you could see it in another YouTube video that I did showing you how to master all your leads and build funnels for them. But if you nurture it and put cold lead because of debt to income, or cold lead because couldn't go approved, or cold lead because not enough equity, or cold lead because of the credit, and you make a list in your CRM for cold lead credit, cold lead income, cold lead valuation, cold lead credit, cold lead couldn't get it approved, whatever it is. And then every single month you send a blast or you call through this cold list, say, hey, I know I talked to you last month, I couldn't get it approved, let's check it out for you again, see if anything's changed. You could nurture these clients and they could eventually turn into business as well. And if you haven't seen that video where I break it down, the exact formula on how to make these lists, make sure you go back and watch it. This is the secret key to getting your loans approved. As a matter of fact, I'm about to take a picture and send it to my team right now because I think they even need this reminder. Make sure you are exhausting all 5 of these bubbles to get a loan approved. If you like this information, that's just a smidge of information that's inside Mastering the Mortgage World collection. Playbook, planner, and a blueprint with categories galore and a virtual training portal that you could search for anything you need like a genie. It has lead by training, credit trigger training, realtor training, program training, guideline training, approve eligible training, social media training, partnership training, networking training, so much more. Mailer training. Every single aspect to Master the Mortgage World is inside. Make sure you get it at acesacademy.com. If you're in leadership, we got the 10 keys of leadership. We also have the 10 keys of sales if you're in sales as well. And we also have free communities for all. Like, subscribe, and share this video with anybody you love, because I just showed you how to get your loan approved.